Many professional analysts and fund managers expect a stock market crash within the next 12 months. Is right now the best time to be investing in the S&P 500, or should we just wait? Okay, so what if you had invested $100,000 at literally the worst time to invest over the last 20 years? You decided to invest all $100,000 of your nest egg right in 2008, right before the financial crisis hit. That year, your $100,000 dropped a whopping 38.49% and was then worth $61,510. Over the next couple years, your money will have creeped back up, and finally in 2013, your money would now be worth $125,971. You'd enjoy mostly good years continuing until about 2022, where we saw a loss total of 19.95%. But then in 2023 and 2024, we had monster years, over 20% gains each. Now, as of 2025, your $100,000 will have grown to $461,797. So literally, you picked the absolute worst time in the past 20 years to invest. You lost a whole bunch of money. Your money went down 40%, but you still ended up at around $500,000. If this doesn't get your attention, I don't know what will. With all this worry in the market right now, people are worried about a crash of maybe 10%, maybe up to 20%. What I just showed you was a crash of 40%, and you still came out on top. Everyone wants the magical formula for retirement. Which stock? Which fund? Which timing? What if I told you you could probably just own the S&P 500, nothing fancy, and do just fine? Probably way better than just fine. It's important to know what's happening macroeconomically and how to invest best, so let me explain my thoughts fully, because if you understand everything in this video, you'll likely beat 99% of investors long term. I'm also going to share exactly how I'm investing here now at the end of 2025. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. To be honest, most of my clients come to me because they tried for decades to pick stocks on their own and now have a portfolio of 40 or 50 stocks that's stressing them out, and at the end of the day actually didn't even beat the basic stock market average. So not only do you have more stress, but you're actually going to end up probably with less money had you just invested in something like the S&P 500. Here's some quick facts that you need to know about the S&P 500, because understanding this is going to make it so that you can beat most investors. Then I'm going to tell you what to do with this information. Since 1957, the S&P 500 has returned on average a bit above 10% with dividends reinvested. I'll give you numbers including inflation later, but the annualized nominal return is about 10.33%. We can generally assume that that's going to continue on average, but remember that past performance doesn't necessarily guarantee future returns. But let me just put this into perspective of what it means to average 10.33%. If you would have invested $100,000 and never put another dollar into this, in 10 years, you'd now have $267,261. In 20 years, again, without investing literally one single extra dollar, you'd have $714,286. In 30 years, you'd now be at $1,909,011. And just for fun, for my university students who I hope are watching this video outside of class hours, in 40 years, you'd be at $5,102,050. And all of that was from investing $100,000 one time, never putting another dollar into it. Most of you knew most of those numbers, or at least understand compound interest, but let me show you why the S&P 500 is my top holding, and why, if you really wanted to simplify literally everything, holding just the S&P 500 could be a very solid option. So first, some cold hard numbers. Like I said, since 1957, the S&P 500 has delivered about 10.33% per year nominal return, including dividends. After accounting for inflation, that drops to roughly 7.5% real return annually over long periods. Over very long time frames, losses versus inflation are rare. For instance, investing $100 in the S&P 500 in 1945 and reinvesting dividends would have yielded about an 11.4% annually nominally and about 7.5% per year after inflation up to now in 2025. Inflation is definitely a thing, and it's going to be something that probably hits even harder over these next 10 to 15 years. So you definitely want to understand that if you are doing a forecast long term, you do want to account for inflation. Since we don't know exactly what the inflation rate will be, you do need to take that with a grain of salt. But it is very smart to understand what your purchasing power might be able to do down the road based on today's numbers. The main thing to get from all of this so far is that if you hold long enough, the power of compounding plus reinvested dividends tends to swamp short-term volatility and heavily outpace inflation. So here's 4 advantages that keeps me heavily invested in the S&P 500. I'm going to hold this for the next 40 or 50 years pretty easily. But then I'll also give you a couple of counterpoints, some reasons why some people aren't investing in the S&P 500, and then I'm going to end with when is the actual best time, especially looking forward, and right now we have some crazy headwinds coming our way. So number 1, the reason why I'm invested so heavy in the S&P 500 is because it has diversification built in. Back in the day when they said diversification is optimal for your portfolio, they were talking about get 30 to 50 individual stocks from different types of industries into your portfolio, and that would be ample diversification. Well, the S&P 500 is 500 of the largest US companies across sectors: tech, industrials, financials, consumer staple, etc. That gives you exposure to many sources of growth and many potential losers, which partially offsets risks. Literally the biggest reason why I'm invested in the S&P 500 is not just the diversification alone, it's that it does all the work for me. I don't have to worry about picking the right stock at the right time, or even selling the right stock at the right time, which is even harder. For those of you that have done this or tried to do this, you understand what I'm talking about. What the S&P 500 does is if it's a good stock, if it's a good company, it brings it into the fund and now you're exposed to it. If it's a really good company, something that keeps growing like Nvidia or Microsoft, it just makes it a heavier weighting within your portfolio, so now you're exposed to more of it. And if the stock does bad and it does poorly over a period of time, the S&P 500 kicks it out so you don't have to be exposed to it anymore. Number 2, the second advantage of the S&P 500 is all about time in the market beats timing the market. The S&P 500 has had many bad years. Some years are negative 20%, negative 30%. But over 20 or 30 year periods, nearly all those spans have strongly positive real returns. From the example that I started this video with, you can see some very terrible years in there, but also some extremely strong years in there, and the green outweighs the red. Looking here, you can see that the vast majority of the time, we have positive years, not negative years. Number 3, investing in the S&P 500 is great because it's all about low cost. Index funds or ETFs that track the S&P 500 have very low fees. My favorite ETFs that track the S&P 500 are VOO, VOO, SPLG, SPY, or IVV. You can see that all these have very low fees. A fee of 0.03% means that for every $10,000 invested, you're only paying $3. I like that. Especially when the alternative is paying a management firm like 1 to 2% to do basically the exact same thing in your portfolio, but just be active management. That's about 50 times more expensive. And the 4th advantage that I love about the S&P 500 is its resilience through crisis, which is very important because we're kind of staring a new crisis straight in the face right now. The US market, and hence the S&P 500, has endured wars, recessions, depressions, tech bubbles, financial crisis, pandemics. Each time over a long enough horizon, the S&P 500 has recovered and gone on to break new highs. Take a look at the chart here, and yes, we have dips. It happens. We go through crisis. But look what happens afterwards. Every single time, the stock market comes right back, and not only comes back, but it beats its all-time highs every single time. Okay, it wouldn't be fair to you if all I did was share with you only the positive things about the S&P 500, because there are risks with investing. Anybody who says everything is rosy and sunshine is definitely just trying to sell you something. So here are some counterpoints, but many of these are manageable, especially if your investing horizon is long-term. This first one is something that we're definitely dealing with right now, and that's valuation risk, or the fact that sometimes it's much too overvalued. When valuations like PE ratios or something are high, forward returns tend to be lower. Some analysts warn that current valuations, like right now in 2025, and the S&P 500 are high, which could mean lower returns over the next decade. The next point against the S&P 500 is its lack of global diversification. It's just about US companies within the S&P 500. The US has been the star performer in recent decades, but that doesn't guarantee future dominance. Studies show that including international equities can smooth returns and reduce risk. Keep in mind, though, that current research does show that 30 to 40% of the revenue in the S&P 500 comes from international exposure. So by owning the S&P 500, you are exposed to global markets. Apple is sold all over the world. Microsoft, McDonald's, Walmart, it's literally everywhere. So on this point, I do think that the more technologically advanced and the more globalized that our system becomes, I think that it's less important to invest in geographical regions, but you should keep this in mind. The last one is just volatility and psychological risk. Drawdowns of negative 30% or negative 50% happen. Not fun. You must be able to stick through them. The math only works if you don't panic sell during those crises like the chart that I showed you. It went down for a little bit, but then it came right back up. And so if you sold because it's going down and never got back in, the only way to get in then would be to get in more expensive. So is right now the best time to be investing into the S&P 500? With geopolitical conflicts, tariff issues, overvalued valuations, AI hype, and the possibility of the dollar losing so much value with inflation, this is a great question. And obviously, I am an academic, I'm a university professor, so I do like to look at history. I like to look back at the charts. Give me some data. Look at what happened in the Great Depression. Look at what happened in the dot-com bubble, and in the financial crisis, and in COVID. Yes, the markets dropped, but then they always came back, and the market has always gone up. During each one of those, people thought the world was ending. It was definitely a very scary time, and it sounded like this time is different. That kind of sounds like what people are saying now and what we're about to go through possibly. Will there be another big event that causes a huge drop in the stock market? Yes. It's not if, it's when, but that shouldn't scare you if you have a long-term investing horizon and are investing for the long term. If you're investing now in 2025 and VOO is about $600 or so, and then something crazy happens in 2026 and we see a 20% dip, now VOO will be around $480. Great, I'll just be buying double or triple as much then, because right now I'm very happy to spend $600 for a VOO share. So I'm even happier to spend $480 for that same share. I know that that dip will be momentary. I understand that it possibly will not be a fun time, and it could take a couple of years to get back out of that dip, but eventually we will, and I will have been happy to buy lower. Just keep in mind, it's been tried and failed by just about everyone, including professionals who spend 8 to 10 hours a day working on this kind of stuff. You cannot time the market, and you cannot beat the market long term. For this fact, I don't try, and the bulk of my investing is just dollar cost averaging into solid, broad, US-based ETFs. And the largest one in my portfolio is the S&P 500. To check out the other two that make up my super simple but very effective 3-fund portfolio, check out this video here where I go over not only all 3 of the ETFs, but also the exact percentage based off of your age, because it does change based off of age in how you should be investing. Or watch this video that I just made, Keep You Going Strong in Investing. Remember to keep investing simplified.